Okay. Let me go. Let me go back there. All right. So, good morning, everybody. This is Fordham Road Collaborative. Thank you very much. As Dennis said, welcome to this. This is our Kushner report for January 22nd. We'll go to 9:15 Pacific, and so we'll have some Q&A at the end. I think, Dennis, any other announcements we need to make?
No, I think that I think we're ready to go. I'm glad everybody's on board. I've got a pretty interesting program today. We've got a number of folks on there that hopefully, will participate. So good morning, everyone, and welcome to the Kushner report for January of 2022. At the conclusion of my presentation this morning, you'll have an opportunity to participate in questions and answers, and hopefully you will.
Just one thing there, of course, those are our email addresses. This is, you go to the website, fordhamroad.net, you'll be able to see this and then get a copy of the video. And Dennis, take it away.
Okay. So what we're going to do this morning, the agenda will be to discuss key economic indicators, the global economy, the domestic economy, mergers and acquisitions, other significant economic news, and what's ahead in 2022. And this morning, we're going to talk about the underlying assumptions for 2022 from an economic perspective. I'm also going to talk a little bit about the valuation of the dollar. So first of all, if we take a look at the assumptions, this is it's a compilation of different comments made by a number of economists around the United States. So first of all, consumer spending will continue, from the cash saved in 2021. There's a lot of pent-up cash out there. People will continue to spend judiciously as we go through the year. So there's still a lot of money out there, and some people that were unemployed for the time being got some large checks, and some of these people are already back at work. So that will continue. The real concern right now is that the supply chain disruptions will continue until late in 2022. And there are various reasons for that, which I'm going to go into. For example, there's issues with having enough trucks and truck drivers to move product at the same time at the docks all around the country. You've got ships backed up out there at sea, 150 miles offshore, trying to unload ships. So it's been a real problem for quite a while now, and that's going to continue. It's getting better, but we're not near where we need to be. And you can see, if you go to stores, you can go to Home Depot, you can go to Walmart, there's still a lot of empty shelves with products that are back ordered because it's just not available. The labor market growth and participation will begin to rebound in 2022. You see now that some people are starting to file for unemployment. They've taken months off. I think we're going to see more people getting out there now, and I'll talk about that later. The last I checked, there was something like 10.2 million jobs opened in the United States. Now, keep in mind, a lot of these people need to increase skill sets to get some of those jobs, but there are plenty of opportunities in the marketplace. So we should see that opening up as we move through, starting in the middle of January and going forward. We should see an impact about an increase in jobs and people going to work. Inflation, as you know, is a serious problem right now, and it will continue high rates through most of 2022. I'll talk a little bit more when I get through the program, and you'll see some things that the Federal Reserve is going to do probably as early as March. So the semiconductor chip shortage will continue into 2023. Now, keep in mind, a couple of things have happened. Last year, when I had my program, I indicated that Intel had spent somewhere between $15 and $20 billion. They're building 2 new chip manufacturing plants in Arizona. And in addition to that, there's a consortium out of Taiwan that's working with some folks in the United States to build 4 factories in that area too, possibly in Utah and in Arizona. And then, of course, Ford has negotiated with one of the companies in Silicon Valley. They'll build chips specifically for Ford Motor Company. And I'll mention later in the program that Intel has made another major announcement, which is good news, about a chip program back east. The economy is strong, but the Fed is going to tighten monetary policy. I think you've heard a little bit about that yesterday, today, and tomorrow. And interest rates may rise as early as March and quarterly in 2022. The target is looking like right now, Powell is saying something like 25 basis points per quarter, which would be basically a point this year, and they'll continue to do that next year. Now, the whole thing is, the concerns are how will different markets react, what will be the implications there, and that'll be slight, but it's going to start moving up. We've got to reduce inflation. That's a serious problem. Capital and durable spending will continue and will increase in 2022. The housing market in 2022 will continue its current path, even in spite of rates going up. Keep in mind, we have low inventories across the country. And therefore, when a house goes up, like when Henry sells his house, you've got 4, 5, 6, 7, 8 bidders for that property. So that's going to continue. Now, keep in mind that as interest rates go up, it'll have a major effect on first-time buyers. It's always had that effect in the past. And again, COVID continues to impact all growth sectors. And like I said earlier, retail sales will continue to be strong throughout the year. It'll be up and down. You'll see perturbations, but it'll strong overall. What I'd like to do here, here's a summary of some points that I'd like to leave with you back on that slide that we just left. And that is this. There's another wave of infections taking place in 2022, which is still continuing to disrupt business. We're going to continue to deal with that for the time being. The quarantine levels have gone down now from as many as 10 to 5 days. We have a lot of labor shortages throughout the country in all vertical markets. Airlines continue to cancel flights. We continue to have supply bottlenecks. Delivery times have been longer and empty shelves in the stores, as we've all seen. The impact also is in China, seeing shipping delays as ports in cities have closed due to the virus causing more disruption. So that's had an impact where we're trying to bring products in from China. The challenges, if you will, the consumer goods coming back, but at what price? I mean, you look around right now. I saw a product the other day that was $2.97 in November. Same product I saw at Home Depot was at $5.67. So prices are going up because they have limited supply. So you're going to have to pay more to get that item. Service costs are going up as well, and of course, housing costs and rental costs will be increasing, causing more upside risk. But keep in mind, the economy is strong, and the Fed is preparing to tighten monetary policy, and they're going to take a hawkish move, if you will, and that'll start in March. So that's kind of where we look at right now. So the other thing is this: we were putting about $120 billion a month, combination of mortgage-backed securities and equity securities in the marketplace, and that's being brought down substantially. So that the expectations are by March we won't see that. It'll be flat. And I think you'll see that the Feds want to later in the year to start reducing their balance sheet and getting rid of a lot of things on the balance sheet. So we'll see that taking place later in the year. I'm not sure when. It could be the late third quarter, early fourth quarter. Now, one thing I want to mention about the dollar, and that's something that everybody's concerned about. The dollar, if you will, in the last few weeks, and especially the first couple of weeks in January, continued to go down. It continues to erode, and the Federal Reserve really hasn't supported it as they should. However, we'll see that starting to change in March. Keep in mind here that the dollar shrinking basically has really helped emerging market currencies that have outperformed the U.S. But we're going to see economists are stating that they believe that the emerging market currencies will come down under pressure in 2022 and 2023 as tighter Fed policy is induced. So we'll see higher bond yields, local political developments result in weaker currencies across the emerging markets. So as I said earlier, starting in March, we're looking at four rate hikes this year, is starting out at 25 basis points. And the Fed's going to watch this very carefully to make sure we don't see an upside down and then begin to hit into a recession. That's the last thing we want to see happen. Okay, our next slide. So what I want to talk about now are key economic indicators. We're going to look at the gross domestic product, inflation, unemployment at the federal level, unemployment at the California level, and the price per barrel of oil. So let's get started here. We'll look at in 2021, it looks like they're going to go out the end of the year in the global economy around 5.8%. That's a pretty good indication. And then they'll drop down to about 4% in 2022. And the U.S. economy right now is pegged to go out at 5.7% and dropping down to 3.9%. Keep in mind, a lot of adjustments continue to be made in January, February, maybe into March on what those final numbers are. Now, we look at inflation on average for the year, it's running around 5.1%, and it could go up as high as 5.2% in 2022. But we'll have to wait and see what the implications are by the Federal Reserve and what that does to the inflation rate going forward. Again, this is kind of unfounded grounds now. This has happened years ago, and we'll see where we go from here. The unemployment rate on the federal level closed out in December at 3.9%. It's projected to go down to 3.8%. California, on the other hand, dropped down to 6.5%, and they expect it to go down to about 5.1% next year. Keep in mind that the California economy tends to be the last to go into a recession and the last to come out of the recession. So our numbers are much higher than the federal average across the board. The biggest concern we have is, and if you remember my last presentation, the upper scale here on the price per barrel is around $90. And there are some people that said within the last week and a half, we could see that number at $100. So I'm not gonna, we'll have to get more details on that to see what happens. But keep in mind this, the price per barrel of oil closed yesterday at $85.14. So it's up. And if you live in California, you're gonna see where we go to summer gasoline, and those prices could go up between 14 and 25 cents a gallon over the next 2 to 3 months. So, and there are those that are saying that very shortly in California, you will see $5 a gallon across the board as a low point. Now taking a look across the globe, the Eurozone in December, they surprised everybody with an upside. It grew at 5% year over year. Although, you know, the underlying inflation measures were steady, but they're slowing down in that area. So we think they've hit the peak in that area. The other thing is that in November, they saw a rise of 4.9%. The real key here is Canada. Their GDP had bounced back. They had an average quarter to quarter their last quarter at 5.4%. They've been struggling all of last year, but they're on the rebound. If we look at China, JP Morgan raised its forecast for the fourth full year quarter for them for 2021, and it's more positive as the trends are getting better. This year, they're projecting they're going out at the end of the year in 2021 at 7.8% on a year-to-year basis. So that's much better than we saw the last 2 years. However, China has vowed they're moving to stabilize their economy. And what they're going to do is they're going to add stimulus to stabilize growth in the next year, vowing more productive measures to reverse the slowdown caused by the worsening property problems we've all seen, as well as weak consumption and the coronavirus. And of course, the United Kingdom had a good month. They were moving in the right direction now. They were up about 0.9 of a point in the quarter, but Australia came in very strong at 7.3% in November. So they're back on target now after being practically flat for months during last year. Now we take a look at the domestic economy, and the key here is Jerome Powell will face a second, but a very tough economy in the second term. And over the first term, basically he was very dovish in his approach to managing the economy, and it's perhaps the most dovish, if you will, in modern history. However, we were focusing on full employment. That was the real key, getting people back to work. However, when we move to the second term, he's going to have to take more of an active role, and it's going to focus on driving down inflation. And some of that may be where it's going to cost jobs. So there's a risk in that environment as well, but we've got to get inflation down and get it under control. It's hurting everybody and every company across the board. Holiday sales and retail sales surged last month in December. For that holiday period, it was up 8.5%. It was the fastest pace in 17 years as shoppers faced, supply disruptions, higher prices, and the spread of corona variants. And in that case, we saw clothing and jewelry sales really increase substantially. Clothing was up 47%, and jewelry was up 32%, and sales of electronic components, et cetera, were up 16%. So online sales overall last year were up 11%, and it's 61% overall since 2019. So that's been very good for all the online retailers. And again, the regular mom and pop shop still did well in spite of that. If we look at the supply chain I mentioned earlier, it's still chaos in the supply chain area affecting shipping and trucking industries, and it's shaping up to be another severe area, or if you will, of severe disruption going forward. So we're under supply chain, and again, the labor content is critical, whether it be in the oil industry, chemicals, everything else. We've got to have more truck drivers and more vehicles on the road to move product. When the signs are that the economy is getting better, we saw a record of 4.5 million people quit their jobs in November. So it's looking like the economy is beginning to bounce back. People are making changes, et cetera. And with aggressive hiring practices last year, we've seen over 18.5 million jobs have been created since April of 2020. So let's take a look at inflation. In December, prices were up 7%. That's the highest it's been in 4 decades. And that's a real serious concern right now. And again, we're going to be taking active steps starting in March. Consumer price index was the fastest that we've indicated in 40 years. The trade exports, good news here, exports were up 37% to $37 billion, which is very good. That's critical for getting our products out of this country. So our local manufacturers and distributors and service providers will see a pickup in their inventories and their pricing. So that's good news for profitability. The trade deficit is still a problem. The trade deficit last month in November was at $80 billion. And again, it's been upward from 67 billion. So that's been a major problem for us ever since we've jumped into the COVID situation. And before that, we were in the 50 to low 60s, but now it's been going in the wrong direction. And hopefully that'll change. Retail sales overall sales dropped 1.9%, and that's the largest decline since February. It stripped away because of spending on automobiles and gas only made it worse. In that case, it would have been 2.5%. Keep in mind, the automobile industry has really suffered because of the lack of semiconductor chips. So you don't have a lot of inventory. Thereby, if you want to buy a car and it's a used car, you're paying a lot more than you would have under normal circumstances. Now let's take a look at the jobs report. So we had a modest 199,000 jobs created in December. The unemployment rate, as I indicated earlier, dropped to 3.9 from 4.2%. And of course, we still have 4.2 million jobs less than February of 2020. The only thing I want to mention here is that business and financial services continue to grow. They've grown for the last 9 months. We see 43,000. And the real sector, 2 sectors. Number one is leisure and hospitality, 53,000. The key here is that that sector's taken the biggest hit since COVID went through, with the people working in hotels and restaurants, et cetera. So it's starting to come back, but it's coming back slowly. And of course, manufacturing is critical. So we saw that job growth. And as I mentioned earlier, we had about 10.6 million jobs that are opening right now as of December. So the California report, we saw a modest, almost 51,000 jobs created in December. The rate went down to 6.5 from 7%, which is substantially too high. We've replaced almost 70% of the jobs that have been lost since COVID. And the only thing to look at here again is the real key is looking at leisure, and that's good. We've seen an increase of 15,000. If you look down below the negative retail of 7,300, the real key here is a lot of those were the jobs that were, temporary jobs around the holiday season, working in, different places. So those jobs are gone. Now, the one thing I will mention, and that is this, from July 31st of 2020 through July 31st of 2021, California had a net loss of 173,000 jobs. The year before that, it was 199,000. So we've lost in 2 years just under 400,000 jobs net, people leaving the state of California. And that's going to continue. Now, looking at interest rates, with inflation passing its 40-year highs, as I said earlier, we're going to see the Federal Reserve take action in March, and we'll see the first 25 basis points sometime in the month of March, and it'll go through quarter by quarter. And if they have to take more aggressive action, they will. The Open Market Committee will double down on pacing the tapering of funding. As I mentioned earlier, the idea is to reduce the amount of money that we're putting into the economy to get it down to flat, to break even sometime, hopefully by the end of March. Mortgage rates jumped in December. The cost of a 30-year fixed loan increased to 3.56%. And this was sometime in January. And then, of course, in the late February, in December, it was 3.22. So we are seeing the rates going up in mortgages. The manufacturing indexes is a real key barometer of our economy. We're seeing that the index dropped down to 57.7, just 1/10 of a point from where it was in the month of December. But the key is here. We have longer lead times to inputs, and also we have another sharp increase in backlogs of work. And it's been the slowest in the last 10 months. So efforts to pass through greater costs to the clients were hampered by softer demand conditions. So you can see that some prices are going up, but they're being very careful in how they raise the prices, because when things turn around, you may lose buyers of your specific products. The good news is when manufacturing is above 50, we're in a good, strong economy. When you drop below, which we were several months ago, it's negative. It means you're in a recession or you're going to go into a recession. Factory orders, again, new orders increased by 6.5 billion. This is the sixth increase in the last 7 months, which is very good in that area. Small business confidence level, we saw it inch up a little bit to 98.9. The real key here is to be over 100. So we're getting closer. And consumer confidence usually is all over the board. This, for the month of December, it was up to 115.8, up from the 111 that we saw in November. So the good news is we're well over the 100. I mentioned crude oil prices. Well, like I said, it was $85.14 yesterday. That's up from $76.58 in late December. So you're saying, that's up almost $9 a gallon, a barrel. Housing starts, again, strong. We saw it rose by 1.4% in December to 1.7 million units on an annual basis. It was milder than usual. Weather allowed for more construction to take place in what is normally a season of slow growth. So this is good. This is good news for that part of the economy. Southern California, sales prices rose 15.8% in December. Still further signs of a hot market here. So if you look at Los Angeles County, the median home price rose 15% to $805,000, but sales fell by 5.8%. Orange County, the sales were up by midpoint of a home is up 17.6% now to 935,000 midpoint, while sales were down 17.5%. And then finally in San Diego, we saw the median price went up 15.2% to 743,000, while sales were down by 11.5%. Keep in mind, this is the time of the year when people are more focused on ending the year and spending time with families and holidays, et cetera. So you don't see a lot of activity. There's activity, but not normally as much as we'd seen for the first time. What's interesting here is first-time buyers accounted for 30% of purchases made in December. That's a huge number. Now, what will that mean when we see interest rates rise? We'll see about the affordability index of people being able to qualify to buy homes as interest rates continue to go up. On the area of productivity, the report, it's only out quarterly. I'm still waiting for the data for the fourth quarter. Perhaps we'll have it in February, worst case in March. The good news here, following company displacements, no company on record right now has had a massive layoffs, anything over 1,000 people. So that's been good for the last 5 months. So what I'd like to do now is take a look at mergers and acquisitions. So for those of you who are familiar with Jack in the Box, they're buying Del Taco for $575 million. What this is going to do, it's going to combine California brands. They'll have over 2,800 restaurants in 25 states. And this will better position them to compete with larger quick service restaurants. So that's good news for them. It'll be interesting to see that combination, how it works out. Hard Rock International is buying Mirage Hotel and Resorts International for over $1 billion, giving the Florida-based casino a prominent place in Las Vegas. So the deal represents a major expansion into the Las Vegas Strip. So that's a big deal from an outsider coming in. American Tower acquires CoreSite for $10 billion. CoreSite consists of 25 data centers, 21 cloud on-ramps, and over 32,000 interconnections in 8 major US markets. So the seasoned management team believes that this is what they need to do to move in a different direction to increase their organic growth. Ericsson is acquiring Vonage for $6.2 billion. This is going to be an all-cash deal. The acquisition, what it's going to do, it's going to expand their presence in wireless and broaden its global offerings and robust performance and growth prospects to build on the Vonage communications platform. Then you look at Oracle is back in the market again. They're looking to buy a company called Cerner for $30 billion. The idea here is to get more active in the electronic medical records business and to deal with that, to grow in that particular marketplace. So they're moving in there. The idea is to get more involved in the medical field, and this will be presence in their sector. So they're always looking for areas to grow. Then we look at AT&T, who's really had some interesting times over the last several years, buying companies that seem not to fit. As you remember, DirecTV, et cetera. So What they're doing is their company is ending its online advertising effort with Zandor division, and they're selling that to, it's valued about $1 billion, and they're selling it off to Microsoft. The idea here, the sale is part of a broader strategy to move to reposition the company. So what other significant news do we have? Well, on the global chip side, first of all, let's start with Black Friday. Sorry about that. Jumped ahead. So Black Friday, the shopping was down by 28%, which was a surprise. Shoppers were spending more throughout the year versus just waiting till the end of the year. And again, this is because of supply chain virus and so forth, getting into stores or getting product availability. So the traffic was down substantially since 2019. Overall traffic was up by 47% in the last couple of years, but this month was not very good as compared to previous months, previous years. So the global chip shortage, as I mentioned earlier, is going to drag on late into 2022. There are, a few bright spots, as I mentioned earlier. More companies are building factories in the United States. We cannot continue to be reliant on offshore development of semiconductor chips. That's killing our economy. And you'll see more of that happening as we go forward. And I'll tell you one more that'll happen in a few moments. Radio Shack, if you remember Radio Shack, it's been around for 100 years. I don't think we have anybody that's 100 years on the group today, but Radio Shack went under in 2015 and filed bankruptcy and closed. Well, Radio Shack announced they're coming back as a cryptocurrency exchange platform in an effort to bring back the old name. So this will be interesting to see how this works over time. So they're coming back with a whole new area of emphasis going forward in the marketplace. Chrysler, like many other automobile companies, is going to be all electric by 2028. It's the latest automaker to make that shift away from gasoline-powered engines under pressure to act for climate change. The first vehicle is targeted to be produced and out on the marketplace by 2025. Amazon is back at it again. They're buying all electric Ram master vans, and all of those should be in place by 2023. So they're getting rid of their whole fleet of gas-driven vehicles and moving to all electric. That ought to be interesting, considering how much these vans are used 24 hours a day and where they're going to charge them and so forth. So that's going to take a lot of planning and development to make sure they're online. If you look at the post office where you live, at least in California, I think all the little trucks that are driving around, they're all electric. So it's been working here in California. Can't explain what it'll do in other parts of the country, especially like David living in Maine. Gas prices remain stubbornly strong. And the current prices on average per gallon was about $3.29 on average across the country. But if you look at where we were over a year ago, gasoline is up almost $1 a gallon across the board. Now, I was in Los Angeles recently to go up to the new modern film museum that's up in Los Angeles. And after it was over, we were driving to have lunch with my colleague and his wife, and got whiplash when I saw a gas station that had gasoline for $6.39 a gallon. So it's going up. There are places in the Bay Area where the gasoline is well over $5 a gallon, somewhere between $5 and $5.75 a gallon. So that's what's going on now where we are. Intel, by the way, announced another major breakthrough. They're going to build a $20 billion semiconductor factory complex. And this will be done in Columbus, Ohio, in which they plan to hire at least 3,000 people. And they'll also hire a lot of people to work in the construction industry. Now, the one thing I wanted to mention, and I hope Kevin Bruce is on the program today, but here's the situation. As we go forward into the year, you're going to see a lot of middle market companies that are violating their covenants on their loans as interest rates go up. And you're going to see a lot of companies filing bankruptcy. You'll see some of the larger corporations come in and take a look at some of these to see if they want to cherry pick them. But right now, going forward, there's a lot of activity moving in that direction where companies are really struggling to stay alive and float. And it's been a real problem, and it's going to get worse until things turn around from an inflation perspective. So having said that, what I'd like to do now is open up for Q&A.
Dennis, we skipped Toyota. Did you want to say anything about Toyota? And
oh, I'm
GM?
sorry. This will make your day. So here's the thing that's interesting. Since 1931, a U.S. automobile manufacturer has always led the country in sales. Last year, Toyota dethroned General Motors. This is the first time since 1931 that a U.S. company has not led the US in sales of vehicles. That was a major shock. So interesting. Toyota had another great year, and they're having a great year in the United States. So let's open up for questions.